Almost 70% of Americans receiving Social Security right now are paying federal income taxes on those benefits. And here is what makes that number so frustrating. Most of them have no idea they are doing it, and even fewer know there are completely legal ways to reduce or eliminate that tax without hiring an expensive accountant or doing anything remotely complicated. I am talking about straightforward strategies that anyone can use, but almost nobody does because the Social Security Administration does not exactly advertise them, and your local tax preparer probably is not bringing them up either. My name is Harold Whitfield. I am a semi-retired elder law attorney here in Asheville, North Carolina. I have been practicing elder law for over 30 years, and I have represented more than 2,000 clients in Social Security cases, Medicare disputes, and retirement planning. And I can tell you from 3 decades of experience that the single biggest missed opportunity I see with retirees is not claiming too early or claiming too late. It is paying taxes on Social Security benefits when they could have legally reduced or avoided that tax altogether with a few smart decisions made at the right time. Now, before we go any further, let me be very clear about what this video is and what it is not. This is not some offshore account scheme. This is not about hiding income or bending the rules. Everything I am going to show you today is completely legal, fully compliant with IRS regulations, and based on the actual tax code as it exists right now. I am not your accountant, and I am not your attorney, but I am your neighbor who has been doing this work for a very long time, and your neighbor is telling you that you are probably paying more tax on your Social Security than you need to. In today's video, I am going to walk you through exactly how Social Security benefits get taxed in the first place, why so many people end up paying when they do not have to, and 3 specific strategies you can use right now to legally reduce or eliminate that tax. And I am going to do it in plain English, no jargon, no confusing IRS speak, just the facts you need to make a smart decision. Now let me tell you a story, because this is exactly how I learned how serious this problem is. About 6 years ago, a couple came into my office. I will call them Robert and Linda. Robert was 68. Linda was 65. They had been retired for 3 years. Robert had worked for 34 years as a maintenance supervisor at a textile mill in North Carolina. Linda had been a school secretary for 26 years. They were not wealthy people, but they had done everything right. They had paid into Social Security their entire working lives. They had a small pension. They had about $180,000 in a 401k that Robert had rolled over when the mill closed. They owned their home outright. They were living on about $52,000 a year combined. Comfortable but not extravagant. Robert came in because he had just gotten a letter from the IRS saying they owed $3,200 in back taxes plus penalties. He was furious. He told me, "Hal, I do not understand this. We are living on Social Security and a little bit from the 401k. We are not rich. How can they tax our Social Security? I already paid taxes on this money when I earned it 40 years ago." And that is the thing. Robert was not wrong to be confused. The way Social Security gets taxed is not intuitive. It is not fair in the way most people think about fairness. But it is the law, and it has been the law since 1983. So I sat down with Robert and Linda, and I went through their taxes line by line. And what I found was this. They were taking about $18,000 a year out of Robert's 401k to supplement their Social Security. Every single dollar of that 401k withdrawal was taxable income. And because of the way the IRS calculates what they call combined income, those 401k withdrawals were pushing them over the threshold where 85% of their Social Security benefits became taxable. Now here is the part that made me angry on their behalf. If Robert had taken that same $18,000 out of a Roth IRA instead of a traditional 401k, it would not have counted as income for the purpose of taxing Social Security. 0. It would have been completely invisible to the IRS formula. they would have owed no federal tax on their Social Security benefits that year. But Robert did not have a Roth IRA. He had a traditional 401k because that is what his employer offered. And nobody ever told him that where you take your retirement money from matters just as much as how much you take. I worked with Robert and Linda for the next 2 years. We did a partial Roth conversion strategy. We adjusted how much they were pulling from the 401k each year. We timed their withdrawals around the tax brackets. And by the time we were done, they went from paying about $4,200 a year in federal taxes to paying about $900 a year. Same lifestyle, same income, same house, just different decisions about where the money came from and when. Robert called me about a year after we finished that work, and he said something I will never forget. He said, "Hal, I spent 34 years paying into Social Security, and nobody ever told me that I would have to pay taxes on it when I retired. And then when I did retire, nobody told me I could do anything about it. If I had not walked into your office, I would have spent the rest of my life paying $4,000 a year in taxes I did not owe. And that is why I am making this video today. So let me explain how this tax actually works. Because if you do not understand the mechanics, none of the strategies I am about to give you will make any sense. And I promise you this is simpler than the IRS makes it sound. The federal government taxes Social Security benefits based on something called your combined income. Now, combined income is not the same as your adjusted gross income. It is not the same as your taxable income. It is its own calculation, and here is the formula. You take your adjusted gross income, which is all your taxable income from wages, pensions, 401k withdrawals, interest, dividends, capital gains, rental income, all of that. Then you add in any tax-exempt interest you earned, like interest from municipal bonds. Then you add in 1/2 of your Social Security benefits. That total is your combined income. Now here is where the thresholds come in. If you are filing as a single person and your combined income is below $25,000, you pay 0 federal tax on your Social Security. None. If your combined income is between $25,000 and $34,000, up to 50% of your Social Security benefits become taxable. And if your combined income is above $34,000, up to 85% of your Social Security benefits become taxable. If you are married filing jointly, the thresholds are higher but not by much. Below $32,000 combined income, you pay 0 tax on Social Security. Between $32,000 and $44,000, up to 50% is taxable. Above $44,000, up to 85% 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 is taxable. Now let me put this in plain English for you. If you are married and your combined income is $45,000 a year, 85% of your Social Security benefit is subject to federal income tax. Not 85% is taken away. 85% becomes part of your taxable income, and then you pay your regular tax rate on that amount. But here is the thing that trips people up. It does not take much income to hit that $44,000 threshold. Let me give you a real example with real numbers. Let us say you are married filing jointly. You and your spouse are both receiving Social Security. Your combined Social Security benefit is $30,000 a year. You also have a small pension of $12,000 a year, and you are taking $10,000 a year out of a traditional IRA to cover expenses. Your adjusted gross income for IRS purposes is $22,000. That is the pension plus the IRA withdrawal. Then you add half of your Social Security, which is $15,000. Your combined income is $37,000. You are over the $32,000 threshold, so now up to 50% of your Social Security, which is $15,000, becomes taxable income. Your actual taxable income is now $37,000, and you are paying federal tax on money you thought was just your retirement benefit. Now here is what makes this so frustrating. Those thresholds I just gave you, $25,000 for single filers and $32,000 for married filers, were set in 1983. They have never been adjusted for inflation, not once in 42 years. If those thresholds had been adjusted for inflation, the single filer threshold today would be about $73,000 and the married threshold would be about $93,000. But Congress never indexed them, so every year inflation pushes more and more retirees over the line. In 1984, the first year this tax went into effect, fewer than 10% of Social Security recipients paid federal income tax on their benefits. Today, it is nearly 70%. That is not because retirees are getting richer, it is because the thresholds are frozen in 1983 dollars. Now I know what some of you are thinking. You are thinking, okay, Harold, I understand how it works, but what am I supposed to do about it? I need that money to live on. I cannot just stop taking withdrawals from my IRA. And you are right, you cannot. But what you can do is be very strategic about where you take your money from, when you take it, and how much you take in any given year. And that is where 90% of retirees miss the opportunity. The first major mistake I see people make is taking too much out of traditional retirement accounts too early in retirement. Here is what happens. Someone retires at 63 or 64. They have not filed for Social Security yet because they are waiting until full retirement age or maybe even age 70 to maximize their benefit. They need income to live on, so they start pulling money out of their traditional IRA or their 401k. They take out $30,000 or $40,000 a year because that is what they need to cover their expenses. They are paying ordinary income tax on that money, but their total tax bill is not terrible because they are in a relatively low bracket. So far, so good. Then they hit full retirement age or age 70, and they file for Social Security. Now they are getting, let us say, $35,000 a year in Social Security benefits. But they still need to pull money out of their IRA because Social Security does not cover everything. So now they are pulling $20,000 a year out of the IRA on top of the $35,000 in Social Security. Their combined income calculation just jumped. Half of their Social Security benefit, which is $17,500, plus the $20,000 IRA withdrawal, gives them a combined income of $37,500. They are now over the threshold. 85% of their Social Security is taxable. Their tax bill just doubled, and they have no idea why. I had a client 2 years ago, a man named Thomas, who came in absolutely baffled by this exact situation. He said, Hal, I am taking less out of my IRA now than I was 5 years ago, but my taxes went up by $3,000. How does that make any sense? And the answer is, it makes perfect sense once you understand the combined income formula. He was taking less from his IRA, but he had started Social Security, and that Social Security benefit pushed him over the cliff. Now here is what Thomas should have done, and here is what I tell every client who is in their late 50s or early 60s and has not filed for Social Security yet. If you have money in a traditional IRA or 401k, and you are going to need to tap that money in retirement anyway, do it before you file for Social Security. Take larger withdrawals in the years before you claim. Fill up the lower tax brackets. If you are married filing jointly and you are in the 12% federal bracket, you can have up to $92,300 in taxable income this year and stay in that bracket. If you only need $50,000 to live on, consider taking another $20,000 or $30,000 out of that IRA and converting it to a Roth. Pay the 12% tax now. Get that money out of the traditional IRA where it is a ticking tax bomb and move it into a Roth where it will never be taxed again and it will never count toward your combined income calculation when you do file for Social Security. This is not some aggressive tax strategy. This is basic tax planning, but almost nobody does it because nobody is thinking 5 years ahead. They are thinking about this year's tax bill and they are trying to minimize it. But minimizing this year's tax bill often means maximizing your lifetime tax bill, and that is the mistake. The second big mistake I see is people not understanding the difference between Roth and traditional withdrawals when it comes to Social Security taxation. A dollar coming out of a traditional IRA and a dollar coming out of a Roth IRA might both be a dollar in your bank account, but they are not the same dollar to the IRS. A traditional IRA withdrawal counts as income. It goes on line 4 of your 1040. It increases your adjusted gross income. It increases your combined income. It can push you over the Social Security taxation threshold. A Roth IRA withdrawal does not count as income if you are over 59.5 and the account has been open for at least 5 years. It is completely invisible to the combined income formula. Zero impact on Social Security taxation. Let me give you an example. Two couples, both age 67, both receiving $30,000 a year in Social Security. Couple A has $200,000 in a traditional IRA. Couple B has $200,000 in a Roth IRA. Both couples need to pull $15,000 a year out of their retirement accounts to supplement Social Security. Couple A pulls $15,000 from the traditional IRA. That $15,000 is taxable income. Their combined income is $15,000 from the IRA plus $15,000, which is half their Social Security, for a total of $30,000. They are right at the threshold. Up to 50% of their Social Security is now taxable. Their federal tax bill is around $2,200. Couple B pulls $15,000 from the Roth IRA. That $15,000 does not count as income. Their combined income is just $15,000, which is half their Social Security. They are well below the $32,000 threshold. Zero tax on Social Security. Their federal tax bill is zero. Same lifestyle, same spending, same Social Security benefit. $4,400 difference in taxes over 2 years just because of where the money came from. Now, I am not saying everyone should convert all their money to a Roth. That is not always the right move. Roth conversions create taxable income in the year you do them, and if you convert too much, you can push yourself into a higher bracket and end up paying more in tax than you save. But what I am saying is this. If you are in your 50s or early 60s, you are not on Social Security yet, and you have a traditional IRA or 401k, you need to sit down with a tax professional and run the numbers on partial Roth conversions before you file for Social Security. Because once you are on Social Security, your window to do this efficiently closes fast. The third thing that costs people thousands in unnecessary Social Security taxes is not paying attention to required minimum distributions. If you have money in a traditional IRA or a traditional 401k, the IRS requires you to start taking money out of those accounts whether you need it or not, starting at age 73. These are called required minimum distributions, or RMDs. And here is the problem. Those RMDs count as income. They increase your combined income, and for a lot of people they push you over the Social Security taxation threshold in a year when you were not planning to take any money out at all. I had a client named Margaret who retired at 64 with a pension and Social Security. She did not need to touch her IRA. She had about $320,000 in there, and her plan was to leave it alone and let it grow for her kids. She was living comfortably on her pension and Social Security, paying very little in taxes. Then she turned 73. The IRS required her to take out about $12,000 that year as her RMD. She did not need the money, but she had to take it. That $12,000 pushed her combined income over the threshold. Suddenly, 85% of her Social Security was taxable. Her tax bill went from $800 a year to $3,200 a year. And it is only going to get worse every year because RMDs go up as you get older. Now here is what Margaret should have done, and here is what I tell everyone in their 60s. If you know you are going to be forced to take RMDs at 73, and those RMDs are going to push you into Social Security taxation, start doing Roth conversions in your 60s before you hit that age. Take money out of the traditional IRA on your own terms, at your own pace, in amounts that keep you in a lower bracket. Convert it to a Roth. Pay the tax now when you can control it, because once you hit 73, the IRS is in control, not you. Now I want to be very clear about something. Not everyone should do a Roth conversion. If you are already in a high tax bracket, if you do not have cash outside the IRA to pay the conversion tax, if you are going to need that IRA money in the next few years, a Roth conversion might not make sense. This is not one-size-fits-all advice. But if you are in your late 50s or 60s, you are in a low tax bracket right now, and you have some time before you need the money, this is one of the most powerful tools you have to reduce lifetime taxes and protect your Social Security from taxation. So let me give you 3 very specific things you can do right now. First, if you are not on Social Security yet, and you have money in a traditional IRA or 401k, sit down with a tax professional and model out a Roth conversion strategy for the next 5 years. Figure out how much you can convert each year without pushing yourself into a higher bracket. This is not something you do once. This is something you do annually, and you adjust based on your income and the tax law. Second, if you are already on Social Security and you are taking money out of retirement accounts, look at where that money is coming from. If you have both traditional and Roth accounts, take from the Roth first if you are close to the combined income threshold. If you only have traditional accounts, consider converting some of that money to a Roth over the next few years so you have tax-free income available later. Third, if you are in your late 60s or early 70s and you have a large traditional IRA, talk to a tax advisor about accelerating withdrawals or conversions before your RMDs start or before they get too large. The goal is to shrink that traditional IRA so the required distributions do not blow up your tax bill when you are 78 or 82. Now, I want to be honest with you. These strategies require planning. They require thinking ahead.